I saw some articles written recently that for whatever reason, that 40 or above or even high 30s might not be necessary, that a series of days with the VIX above 30 in the past has set up a tradable bounce. Am I clutching at straws there, Amy?
Yeah, it's interesting because I think a lot of the technicals around the VIX is very psychological. At the end of the day, a 30 VIX just means the stock market is moving 1.8% per day. That's essentially what you're saying versus 1.2%, which would be about a 20 VIX. The reality is structurally, the way to think about it is, okay, in history in different bear markets, where did VIX peak? And you've had peaks of 80, and you've had sustainable peaks at 42. So I think what it comes down to is how much VIX has caught up versus other volatilities and rates and cross asset. And we're still not quite there yet in terms of how those have moved relative to the VIX.
How about, breadth being unbelievably negative, sentiment negative, put call? Anything there that's at extreme levels, or are you surprised maybe that you're actually seeing some complacency even after this pretty brutal sell-off?
Yeah, it's interesting, because I think the narrative during the sell-off last week was, look at these put-call ratios. They've hit these historical highs. That is technically true, but it was true on a very short-term basis, not on a longer-term history, right? I think as well as anyone, you can always game the data by pulling that chart 1 year back versus 5 years back. So, on a longer-dated history, a lot of these metrics we look at, so put-call ratios or the demand for hedges, they're still not that historically high. They're actually sitting in their bottom quartile. And we're entering an environment when you look at volatility across different rate cycles, there's a lot more room in terms of where those percentiles ultimately end up going. That being said, I think the breadth has returned somewhat to the market, which does help because there's been some situations where, one or two extremely large trades are moving the market during low volume kind of vacuums that we'll see less of if there's more volume returning to the market.
Are you still with us, Gabriela, or did you leave and you're saying sell everything on the phone somewhere? What does this make you inclined to do, Gabriela? Or do you agree?
So I think strategically there's a lot of room for optimism. We've seen a significant repricing. There's now income and fixed income. There are now more discounted valuations on the equity side and the currency side. So we're very optimistic about longer term returns. Coming into the year, the macro picture was positive, but the return picture wasn't. We were saying expect only 4% annualized returns. Now, if you look over the next decade, we're expecting 6% plus annualized returns. But the trick is more on the tactical positioning. We still think it's too early to add risk wholesale. We would still be underweight equities, underweight high yield credit, because we still don't see day-to-day signs of stabilization in the bond market, in the FX market, and hence in the equity market. So we're being careful about how we take risk and exactly where we take risk.
When you're long-term and when you're a fundamental strategist, I guess entry points make a difference. But if you're right about the eventual direction, you can be bailed out. Do you think about capitulation, Gabriela? Do you think about a big move down, which all the technical analysts seem to want right now? Would that just be a time when you'd really, go to less cash? Or do you just sort of, I don't know, just stay calm and when you see opportunities, you do it? Do you look for a big capitulation at some point?
So that we are looking for signs that really we have the worst already priced in and positioned for in portfolios. We just don't think we're quite there yet. I think ultimately the big questions that investors are wrestling with right now is that we've moved away from an era of negative real rates to an era of positive real rates. This 160 positive real rate we have right now is not a fluke. It's something that's here to stay. And it leads to two questions. What is the appropriate risk premium investors should demand for in long-dated bond yields, in FX, in credit, in equities? It's different than it was over the past decade. And it also leads to questions about elevated recession probabilities. We still don't think the bond market has stabilized. We're seeing a lot of big moves on a day-to-day basis. For example, we still see very low appetite for bonds, even at yields at 15-year highs. We had a very poor 5-year auction yesterday. So we look first to stability and demand coming back to the bond market. For the equity market, for us, signs of capitulation would be being further along in the downgrade of earnings expectations for 2023. And we think we're really just at the beginning of that in terms of pricing in lower demand, higher cost pressures, higher dollar, as well as higher corporate tax rates next year.